Yeah. So, so great to have all of you here now. And then I think, Salil, you can start off with your presentation.
Okay, cool. I'll just share my screen. You guys able to see it, right?
Yes.
Okay, cool. Yeah, so hi guys, hi everyone. I'm Salil Naik from Trek One, and my topic for discussion is synthetic protocol. Right. So you able to see the PPT, all of you?
Yes.
Yes.
Okay. So since I'm starting out, I'll just put a light on what DeFi is or decentralized finance is. It refers to the financial services using smart contracts, which are automated enforceable agreements that don't need intermediaries like banks or lawyers to use banks or lawyers. Okay, and it uses the blockchain technology. So synthetics is an Ethereum-based protocol for the issuance of synthetic assets. Okay, so in order to understand this, we'll have to know what synthetic assets are. So, so So, now this term is not specific to crypto or DeFi. Instead, it is something that has long been there in traditional finance, this term synthetic assets. And as per definition, synthetic assets is a financial instrument that derives its value from other assets. Now, let me give an example here. We have S gold and gold, right? So S gold is nothing but an imitation or a simulation of the real world asset that is gold. So to explain you, let me give an example of Dream 11. You guys might have heard about this game, right? Dream 11, where you choose your playing 11. And depending on the player's performance on field, you get some money. But your playing 11 is just a simulation of those real players. Similarly, here, S Gold is just an imitation of gold, which is the real asset. And here are some examples like we have Ethereum, S Ethereum or synthetic Ethereum, USD, S USD, Bitcoin, S Bitcoin, and so on. And synthetic asset allows the traders to take position in an asset without actually spending the capital to directly buy or sell that asset. So though this gives the traders an exposure to real world asset, it won't really give them the dividend that the actual stockholders get. So that's kind of a negative point of it. So again, coming back to synthetics, it is an Ethereum-based protocol for the issuance of synthetic assets. Now we know what synthetic assets are. Or in other words, synthetics at its core a trading platform for synthetic assets, which is built on top of Ethereum blockchain. Yeah, so how it works? The screenshot which you see is of Quanta. Now, Quanta is by Synthetics, which is a decentralized exchange or DEX on which you can trade synthetic assets. And unlike other DEX, the exchange utilizes peer-to-contract trading, meaning all the trading are executed against a smart contract. Right. And synthetic assets are known as synths. So synths use decentralized information service providers known as oracles to track the price of the assets represented, like to track the price of the gold and Bitcoin. And that allows you to hold and exchange synths as if you actually own the underlying assets. Remember gold and S gold, right? I'm talking about that here. And in this manner, synths provide exposure to assets which are normally inaccessible to average crypto investor, like gold and silver, which are not really accessible to average crypto investor. And then it lets you trade quickly and efficiently. Okay, so these are some steps to trade. First, you need a Web3 wallet. It could be any wallet like Opera or MetaMask, Trust Wallet, etc. And we need to connect it to Penta. Okay, and then we need to acquire USD or any other synths on DApps like Uniswap or Bunny. And the third step is to trade between the entire range of synths. So the range of synths, I guess I have a slide for that. Yeah, so we have traditional equities, forex, cryptocurrencies, commodities, etc. Coming to SNX, so SNX is SNX, the full form is SNX is Synthetics Network Token, and it is the utility token of the entire synthetics ecosystem. So users purchase SNX tokens and lock it up as collateral to create synths. Right. So this brings me to another way to trade. The user can obtain SNX token on an exchange and then stake them on Minter. Now, Minter is another decentralized application created by Synthix to mint and burn SNX tokens. And the third step is to create synth and begin trading them on Quenta. Yeah, so this was about synthetics. And Denver, do I need to explain my project idea now itself?
Yeah, you can explain it now.
Okay, cool. Uh, yeah, so I kept my project idea fairly simple, and that is the reason I don't have slides for it. So I'm trying to create a dashboard by accessing the synthetic system data, and I will use that data to show the SNX price, that is the synthetics networks token price, SNX market cap, price of maybe the top synthetic assets like BTC and USD, SBTC and SUSD, sorry. And I'll show a distribution of synths within the synthetics protocol with the help of a pie chart and some other graphs as well. So this is the entire idea of my project. And for that, I'm using, I'll just share my screen. Okay, I don't know the URL to that, but Synthetic provides three options to integrate their protocol with RDFs. And one of the options is to get that data, rich data, and build something on top of it. So that I'm trying to do. So that's my project idea.
Sounds good. Anybody, any questions?
I just had one question. So the idea that you talked about, so like you said that you're gonna be extracting the data and using it for the dashboard, right? So like, is it going to be a decentralized app? Like, will you have to write a smart contract for that?
Yes, I will have to write a smart contract for that.
Okay.
I have a question.
Yes.
Suppose we have cryptocurrency and you have the synthetic asset for the cryptocurrency.
Hmm.
How does trading in the synthetic asset instead of the actual thing, how does it differ? Like, you do get the prices for the synthetic thing from
Yeah,
the
yeah,
actual
yeah.
ones, right? So why would I use the synthetic asset instead of the actual one?
Yeah, actually, I had the very same question. And while researching more about it, I came to know that, it sometimes, suppose I want to get into trading, and instead of directly investing into gold or the real world assets, I can instead use synthetics to create synthetic assets and, invest here. And the plus point of this is I can just, you know, transfer the tokens to some other commodity or other cryptocurrency, which does not really happen. Maybe mentors can correct me if I'm wrong. I can suppose I buy S gold. I can transfer that S gold to SBTC whenever I want. That does not happen in real world trading, if I understand it properly.
Okay, and so just one thing here, how is it actually linked to the real world asset? Is it linked in
Uh,
some way?
yes, so it is not linked, but there's something called as oracles.
Okay.
Just, yeah. So these are the third party. I don't know this.
Yeah, so the price feed comes from the oracles.
Yeah, so it's a blockchain protocol, and they take the price of the real world asset and give that information to the DFs.
Okay,
So that is how it is linked.
fair enough. All right, Salil, thanks for that presentation. I
Yeah,
think we can now move on to Neeraj.
yeah. Thank you so much, everyone.
Yeah.
Hello guys.
Hey.
Yeah. So my protocol was open. So let me just share my screen. Right. Oh, this control is. Okay. So open finance. So it's a DeFi option market on Ethereum. So what is option? First, we need to understand that. So options are financial instruments that are derivatives based on the value of underlying asset, such as ETH or BTC. And so an option contract offers the buyer the opportunity to buy or sell the underlying assets. So buyer of the contract have protection against variation in price of the actual asset if he buys option. So how does it work? Wait, let's just first type of options. So first call options. A call options is a financial contract that gives the option buyer the right to buy an asset at a specified price for a specific amount of time. So this specified price is a strike price, and the specified amount of time can be anything which is in future. So if so for example we have current price of Ethereum at 2000 USD, and in future I suspect that price is going to get up because of some now new DeFi protocol has been introduced. So I think that price will go up to 2100 USD. So what I want to do is I want to buy Ethereum so that I can earn more money. But I am not sure that price will go up. So it can be the case that smart contract don't work well and price actually goes down. So what we do is we can buy and call option. So in call option, I will say that I will buy 2100 call option in the end of this month. So it will expire on the end of this month. So at the end of this month, I have right to buy Ethereum at 2100 price, and it will be profitable for me if the price of Ethereum is higher than $2,100 at that point in time. So this kind of protection call option can give you. And seller of this option, you have to offer a seller of this option premium for gaining this option. And so there is a put option. So in put option, so it is like opposite of call option. In call option, you have right to buy certain asset, while in put option you have right to sell certain asset. So if you suspect that price of Ethereum is going to go down in certain amount of time from now, you want right to sell your asset at certain price, which can be anything like currently price is 2000 USD, and you suspect that price is going down to 1500 USD. So you want to sell this asset in 1800 USD. You can put an option to sell this asset in 1800 USD. So at the end of this month, if price of this asset is less than 1800 asset, you can exercise the put option and can sell this asset in 1800 USD. Okay, so what is so there are types of options like long options and short options. So what is long options? Long options are any options, calls or puts that you pay for in order to acquire. So if you are buying an option Yes, it is long option. But if you are selling some option, it is short option. So now let me just share a quick demo of it. Okay, so this is open.co.trad, and I am running Covan testnet. So here is call. So there is a strike price of 1600 USD, and premium is $445, and this is a break even, so actual price. So this amount, so this is a premium price plus strike price. This is break even. So if I want to buy this call option, okay. So first of all, let's buy 0.5. I don't. So total cost will be 45 USDC, and payout analysis. So max gain is infinite and max loss is 53, which is premium. So this is a premium amount that we need to pay. And here they have shown us that options are exercised at expiry and cannot be exercised prior. So I can only exercise the option at expiry. So I can't sell it. So I can't. So if I have an option to sell Ethereum at end of the month, I can't sell it before the end of the month. So it is so I only exercise it at the end of the expiry date. And this is auto exercise. So if I am going to get profit from this option, then it will auto exercise and I can redeem it afterward. So this is functionality provided by Open Team. So now I can buy any. Okay, I have notification. Transaction has started. All right. So I can see it on Etherscan. Oh, it is processing. Okay, let's.
Yeah, Neeraj.
Hmm?
While this happens, maybe you can talk about the idea that you thought about.
Yeah.
Because like we have less time.
Actually, I had one question.
Yeah, so this is 0.1. So I have this 0.1 W 26 February. This is going to expire on 26 February, and it is 1600 call. And I have 0.1 auto count for it. Okay.
Hello, Neeraj.
Yeah.
Yes, actually, I had one question. How is the strike price for the option is decided?
Okay. So strike price. So strike price can be anything. So option seller is going to decide the strike price.
Okay, so like OPVIN is like the open options trading platform, right? So where lenders and sellers and buyers are like communicating with each other.
Yeah.
Okay, got it. Thank you.
Okay.
So like one more thing. So you said that the price is decided by the option seller. So like for example, I decide like what is the profit that they're making? Like are they generating interest out of it? Like for example, I may set it to be, say, if my
Yeah. So you are going to get premium out of it. So
Yes.
if someone buy an option, they have to pay premium And this premium is derived from other factors like delta and uh, other. So
Okay.
there are numerous of these symbols, the delta and theta and vega. And so all of this combined is going to derive all this uh,
Okay,
term.
okay, I get it. I get it. Thanks.
Yeah. So, okay. So now let me show you what am I going to do in project. So OPIN provides operator protocol. So operator protocol can manage OPIN walls through some smart contract. So uh, I can have an OPIN vault, and I can give operator access to any smart contract so that a smart contract can do any transaction on behalf of me. Okay. So what is an action? So actions are anything that can be done on protocol. So all action except redeem and call are on open walls, while redeem can be on anything like I can uh, redeem my tokens on another account or on my own account. And call is any action that so call action allow me to call any other smart contract. So there are this struct provided by open team. This is we need to use this also. So this is action types. So there are different action types like open vault. Open vault action type can open a new vault for an account. Mint sort option, which will mint a token from a vault. Burn a token, burn sort option will burn a token from a vault. And there are all these different action type which we can use to create a call option or put option or create a complex strategy on top of that. So now on ideation stage, what I decide is create an operator for bull call spread strategy. So on this option market, we have various strategies like bull call spread and bear call spread and other put counterpart of it. So what bull call spread strategy is? So I want to generate profit from. So if I suspect that price of certain asset is going to go up in near future, then I want to generate profit from it. So if current price of an Ethereum, so let's for example take Ethereum. If current price of Ethereum is 2000 USD and I suspect that it is going to get about 2100 USD, then I want to get a profit from it. So what I do is, first of all, I create a call option for a 2100 strike price. And then then I want to sell this call option for lower price. Right now for a higher price. So 2100. So I want to sell call option for 2200 US. So what it does is we don't need to pay that much premium that we have to pay otherwise. So if price will go above 2200 USD, then someone is going to so wait, let me so if a price will go up to 2100 USD and remain between 2200 USD, then I won't have that much loss. For example, let's say at the expiry price is 2200 USD. Then
Neeraj, sorry to interrupt, but I think we are extended. We have gone beyond the time.
Yeah.
Maybe you could just like give a brief and then go on.
Yeah. So I'm going to provide so we can do this in multiple step currently on OPIN, but I want to provide us operator that can do it in single step.
Okay.
So will be the gist of.
Great. Sounds good. Also, everyone, we also have Siddharth with us on the call now. Siddharth is the co-founder at DeFi Dollar. Glad to have him here.
Hey guys,
Hey,
thanks.
Siddharth.
Yeah.
Oh, Defolio t-shirt. Nice.
Yeah.
मैंने नहीं पहना आज Defolio t-shirt.
नहीं हम represent कर रहे हैं कोई नहीं.
सही है बढ़िया.
I think I'll also just change my t-shirt and join.
Sure. Great. So we were just doing some presentations. So okay, we have Arth also with us. Arth, thanks for joining in. We have Pranav also with us. And I'm not sure if other mentors are there, but then yeah. Thanks for joining in.
And how many have already happened?
So only 2 have happened so far.
Cool. Sorry,
Kind
guys,
of,
late.
yeah, kind of these 2 were a bit slow. We'll stick to a time slot of 7 per for the rest of them. Maybe 5 minutes for them to just speak about the protocol they have chosen and a brief of the idea. 2 minutes for any questions people might have.
Sure, and we can ask questions right away after the 5 minutes, right?
Yes, after the 5 minutes.
Cool.
Questions, and then we'll just finish them. Aim to finish everyone in 7 minutes.
Superb.
Yeah. So I think who's supposed to be next? Just give me a minute. Check. Yeah, after Neeraj is Uday. Uday, can you start off?
Let me share my screen.
Yeah.
I hope my screen is visible
Yes,
and not my show notes.
It is.
Yeah, so hello everyone, my name is Uday and I'm from Team Earth, and today I'm here to present you Yearn Finance, the most exciting project in DeFi space, which you all definitely want to invest in after this presentation. So Yearn Finance is based on the Yearn protocol. Yearn protocol is a set of Ethereum smart contract based on focused on creating a simple way to generate high returns for depositors of various assets while lending protocols, liquidity pools, and community-made yield farming strategies on Ethereum. So how it works? Made by Andrik Ronch, it is an idea to automate strategies for lending money between different DeFi protocols. The main element is a yield optimizer, which automatically switches between different yielding protocols for maximum returns. So let's say you have some stable coins and you want to make your money grow. There are different protocols in DeFi space like Maker, Aave, and Compound, where you can give them your money, which they will lend out to those who need them, redeem them back with some interest, and give you the original money with some interest. Now, let's say you have noticed that some lenders have higher rate of return. In that case, you have to manually transfer your investment, which Yearn Yearn protocol will do it exactly for you. Taking DAI as an example, which is a stable coin, you deposit your money into a pool, and in return, you will receive some equivalent Y token, which in our case, YDAI. Then this money in the pool is used to invest in different DeFi protocols like Maker, Aave, and Compound. It automatically switches between them, whoever is providing the highest rate of return. And whenever you want to redeem your stablecoin, you give them back their Y token and get the original stablecoin with some interest. So let's do a recap. It creates a pool of stablecoins. When you deposit your stablecoin, you get a Y equivalent in return. The protocol then decides to move fund between different protocols to maximize the interest earned. You can redeem your Y stablecoin by giving back the Y token. The protocol makes sure that you receive the equivalent stablecoin and not from any other. So there are a lot of features that could be added to this, and also some problems arose after the version 1. So there was a need to create the version 2. There are many different kinds of stable coins like DAI, USDC, USDT. So we need an exchange to swap their Y equivalent like YDAI, Y USDC. So Yearn partnered with Curve to do so. With the introduction of Compound token, another
a lending service in DeFi, the strategy of won't work efficiently, because then the whole concept of governance comes in the compound. And also the balance of the pool was maintained every time a user deposited or withdrew their money, resulting in huge gas price. Also, when huge pools started to form, they needed a better strategy for managing these pools by splitting the funds between different protocols to optimize the returns. To overcome these problems, they created a vault. A vault is basically it's like a massive pool with its own strategy. Vault benefits by socializing the gas cost, automating yield generation and rebalancing process, and also shifts the capital as the opportunity rises. End user do not have to have to have a proficient knowledge about these underlying protocol. They can just invest their monies in their vault, and the vault will do everything for that. Every vault has a strategy attached to it. It's just like hedge funds, and like it gets quite complicated. So I wanted to like explain one part of it. Let's say a vault has two types of funds. One is ideal amount and the other is strategy pool. The money in the strategy pool is invested in different DeFi protocols, and whoever wants to deposit or take their money gives first deposits and or withdrew it from this savings pool. But when the savings pool gets depleted, the when they withdraw, they have to go to the strategy pool, which then takes back the money from different lending protocols and gives them back. But that results in some gas fees. To further decentralize the protocol, providing other people to make meaningful decisions, Wi-Fi token was introduced. Wi-Fi is a governance token. It means it has zero financial value. To maintain the transparency, no team's rewards were allocated at the time of offerings. No tokens were pre-mined. About 10,000 tokens were allocated to liquidity providers of CRV pools like the Curve liquidity, that platform for exchange. And in total, about 30,000 tokens were distributed, which logged in a value of more than 600 million. Last year, August, Wi-Fi, the value of Wi-Fi surpassed Bitcoin for the first time, and analysts suggest that it will be the first token to surpass $100,000. And this 6 days is actually 6 days from now, so you can think of them like 7 days ago. And but now you may ask that a Wi-Fi token is a governance token. It is just for making decisions. So why it is so much valuable? Vaults also provide liquidity. Wi-Fi holders with access to the token also gets a portion of protocol's profits. So basically, the more it's basically like hedge funds in real world. So the more you have the decision powers, the more you will be able to invest in different lending protocols and manage these funds, and you will indirectly earn money. Yearn Finance also introduced some other projects as well, like Yearn, Zap, and Cover. And Ensure, this one missing here. Ensure is for insurance of these protocols. Earn is a liquidity aggregator to provide funds for other protocols. And Zap is to reduce the transaction cost between the other tokens. The future of Yearn Finance is quite bright. They have recently hired a team of developers and marketers, and like based on analyst reviews, they have already surpassed Bitcoin at this point and will be the first cryptocurrency to hit 100,000. So the future is quite bright for Yearn. 2 weeks back, they also got hacked in some way. One of their DAI vaults lost about $11 million, but still there was no dent in the overall vaults, and like they're still going strong. So for the project, the thing is, this Yearn Finance and all the protocols basically only work on the mainnet. They do not have anything to do any testnet thing or something like that. Even like the creator of Yearn protocol, Andrew Cronch, has its Twitter bio as "I test in prod." So my project was to create a alert system. I slid into their Discord server 2 to 3 days back, and like a lot of people were talking about this, that after the hack, they needed an alert system to like they needed a dashboard and alert system to look at where all their funds are going. So that's what I'm started to work upon, because all the other, like I went through their source code and all the functionality that Ian has already implemented in the product, and this was one of the features that can be implemented easily without actually deploying anything to the mainnet. So yeah,
Nice.
that's it
Nice.
for my part.
Any questions? Anybody else has any questions about this? About Jan?
Uday, are you making this dashboard for a particular vault, or are you targeting like all of them in a single?
For now, I have taken 4 different stable coins: DAI, USDC, USDC, and BUSD.
Okay.
There are also, like, I have to look at other vault source code also to figure out which functions are available for me to like grab the data and look create a dashboard.
Got it. Is there anything you have that I can look at probably, or is it still under
Yeah,
development?
they've just actually just started. They just did most of the ideation now. So
Got it. Cool.
Yeah.
No, would love to take a look there and hit me up, right, in case you
Yeah,
have
sure.
anything. Yeah.
So anyone else have any questions for me? I hope my protocol was clear.
Yeah, dude, you rocked, Jan.
Yeah, I definitely think everyone we start looking in what's this money making machine. I was quite fascinated.
One thing I would definitely suggest you is that, in the yarn strategies that currently happen, because of the gas price, you have to pay a lot, and that actually minimizes the profit you're getting for.
Yeah, so I looked into it. So what Yarn do is like they batch up their transactions and then socialize the gas for them. They distribute it.
Right. But still, what as per my, staking contract and all of them are a big trouble right now in the current ecosystem and industry. What I would suggest, if you want to make a change or, diversify your things, then deploy your contract or whatever you're doing, maybe a part of it on the layer 2 and, make it communicate with layer 1 if you are, that much in the advanced stages. So yeah, that would
I'll
be a
definitely
suggestion.
have it in my to-do list and look into it.
Right.
Yeah, that would be great. Like anyway, Yon is taking care of all the things in between that gas. But then even if that becomes less, because it's not cheap. I know it's not cheap.
using so what I believe, despite being new to the blockchain ecosystem, I believe you can create a change, right? What you're doing is really great and perfect, but if you want, to make it a little popular, I would suggest you to go for a layer 2. There are many dexes that currently exist on layer 1. There are hundreds of dexes, but Uniswap has already captured most of the market. Whatever was remaining was captured by Sushi. So what's the next thing that you can do? Stop making decks? No. Deploy your decks on the layer 2. For example, QuickSwap, which is aggregated about 100 times from now, from $10 to $180. Something like HoneySwap, right? So that's the next big thing that you can go for. So if you're deploying your thing on the mainnet, that's cool. But if you want to make a change or want to make a mark just by your first project, deploy that project on the layer 2. That's again a suggestion, not by Matic. You can just take that. But yeah, that's
sure
thing.
Definitely I'll look into it.
All right, let's go with the next person. Is Uday?
Yeah, it's me.
Sorry, I'm not very sorry. It's Rahul.
Hello, good evening, everyone. Let me share my screen. Okay, is my screen visible right now?
Yes, it is.
And now the presentation mode, right?
Yeah.
So the protocol that I was assigned was the Nexus Mutual Protocol, and today I'll try to explain this protocol to you. So Nexus Mutual, along with being a protocol, is an insurance company, and I am like sort of an insurance company. But I am very happy that like Uday just explained what staking is, and I'd like to just add one more term that what he told about Yearn, it's called yield farming, if I'm not wrong. So now we are all familiar with the concept of staking your coins and yield farming. So you are basically putting your coins somewhere. So whenever you are putting your coins somewhere, and that's a form of investment, right? So in any investment, there is an inherent risk based on the type of business that you have put your coins in. So this is the problem that Nexus Mutual has been trying to solve recently. So it's just in December 2020 that they have started covering these staking claims. And originally it started in July 2019, and it covered the security of smart contracts. So let's start. So what is Nexus Mutual? Nexus Mutual is a decentralized alternative to the conventional insurance companies. Okay. I'll later come on to why it's not an insurance company per se and what it is. So it's a decentralized alternative to insurance. It uses blockchain to create a mutual, which you can think of it as a risk sharing pool to return the power of insurance to the people. We'll get to know that how insurance actually happened in the earlier days before the companies came in. And Nexus Mutual is wholly owned by its members. So you have to pay some fee like around 0.0002 or 4 Ethereum, like Ethers, to be a member of Nexus Mutual. And after some KYC, you get to be a member of Nexus Mutual, and then you directly become an owner of this company. There is no like customer or employee kind of thing here. So the model of Nexus Mutual encourages participation in the functioning of Nexus Mutual as they get economic incentives for participating in risk assessment, claim assessment, and governance. So again, in risk assessment, claim assessment, and in governance, you have to stake your coins to build confidence in whatever your opinion is. So coins are exclusive to Nexus Mutual. They are called NXM. And risk assessment and claim assessment is of the smart contracts that are being brought to Nexus Mutual for insurance. So, okay, what is Nexus Mutual's model of insurance? So this goes to the very basics of insurance. The first time if anyone thought of insurance. So this concept of insurance comes from communities in the past that pooled their resources to protect each other from the risk they all faced. So suppose we are a very small group of people, and we pool together in emergency fund to save each other's back if any like emergency medical situation happen to each of us, any of us. So it works better the more people are in the pool, as the number becomes more predictable. It's a law of large numbers. So you can basically predict that how much money would be required in a year and so on, and how much money you'd like to collect from the members. But as this model was based on trust, it was not scalable. The number of people you can know and you can trust is pretty low. It's around 150. So this model was not scalable for insuring. Hence, traditional companies emerged. The traditional insurance companies acted as a middleman, and they basically, in lieu of your insuring your asset, they took care of the asset, and like they became the pillar that you can trust for your insurance needs. Nexus Mutual therefore built a platform where individuals only needed to trust the system, not everyone in it. So what Nexus Mutual has done is that it has created a community. Nexus Mutual, as I told you, is a community of members, and there they do not explicitly trust the people in the network, but they trust the process of Nexus Mutual's handling of risks and insurance covers. So why is insurance required in the DeFi space? So DeFi is actually pretty interesting and a dynamic field right now. This also means that there will be a little of haste from the developers, and this results in like millions of dollars lost in smart contracts that were exploited by the hackers. And this is the list of recent attacks that have happened. Uh, if anyone wants to read about them, they can just take a screenshot of this page. Okay, so also why DeFi requires insurance is that it has a large pretty large amount of money locked in DeFi contracts right now. So as the value stands right now, it is currently about $20 billion worth of smart contracts in the Ethereum chain itself. So Nexus Mutual has been enthusiastically received by the crypto community. So how do we know that? We know that because a humongous amount of finance have been added to the pool of Nexus Mutual. The company started just back in July 2019, but by January 2021, the Nexus pool, or the combined pool of resources from which claims are given, has $152 million in total and $75 million locked up in active insurances. So that's a pretty good ratio and a pretty good number for a young company. So this is the graph that shows the values logged in Nexus Mutual pools. And anyone can take screenshots of this if they want to study it. Okay, right. So what are the products that Nexus Mutual offers? So Nexus Mutual offers two types of covers. So the first cover is very normal, as we discussed it, smart contracts cover. So if a company has decided to deploy a smart contract on a blockchain, and they want some kind of insurance, if that smart contract suppose it deals with a lot of money of your customers, or of someone else you're like handling the money, so you want some kind of insurance for your money. So you can go to Nexus Mutual and ask them to cover your smart contracts. And also it has recently in December 2020 started covering custody cover. And custody you can think of just as explained by Uday in the last presentation. It's basically staking and related fields where you give your cryptocurrencies to a certain custodian as an investment. And in that case, if the custodian gets hacked and user loses more than 10% of their funds, or withdrawal from the custodian are halted for more than 90 days, you are eligible for a payout. So remember, there are no customers in Nexus Mutual. If you want to buy a cover, you have to become a member, because remember, Nexus Mutual is not a company. Nexus Mutual is a community, and you get the right to buy a cover by becoming a member. Okay. So how does Nexus Mutual work? So people who join the mutual, as I told you, by paying a nominal fee, become members, and member can buy covers to protect against hacks in smart contract code. Okay, it is a mutual. You can think of it as a cooperative in India, like the Amul cooperative. Nobody owns it, but everybody owns it. That's the concept of mutual. So it is a mutual, and each member can have tokens. That's called the NXM token, which represents their membership. So based on voting from the members, a board of director also exists that have a few additional powers compared to the members. And those power include a stop functionality where they can stop all the ongoing and scheduled transactions immediately, like put a halt to it if they find something is amiss, or if they suspect that some wrongdoing is going on. So even though a board of executives exist, they are elected from the members. Hence, they can be replaced very easily by creating another election and replacing them. And it runs on the Ethereum blockchain. So once you become a member, so once you are a part of the Nexus Mutual community, what can you do? So first, of course, you can buy smart contract covers. Second, you can contribute funds to the mutual and hold NXM tokens. So you get NXM tokens when you become a member, and you can contribute funds to the mutual. So you can also stake on smart contracts, which you think they are safe, and earn rewards. So as Uday told about Yearn, here you can stake on smart contracts. Suppose you see a smart contract and a person wants insurance on it, and you have a pretty good idea of contract development, and you have a look at it and you think it is pretty safe. So you stake some NXMs on that contract, and if everything goes well and safe for the period for which he's asking cover, then you get a reward out of it. And for the functioning of the NXM, you also can put forward governance proposals. You can vote on proposals put by others, and all members of the mutual are sharing risk with each other. Because again, it's not a company, it's a community doing insurance for each other. Things that Nexus Mutual has developed. Okay, so the thing is that before the community, the founder, what he and his team has developed is base pricing. So base pricing is calculated based on centuries of actuarial economics. So base pricing is the basic price that will be asked for your smart contract. And since actuarial economics and actuarial science is a pretty difficult and like, what can I say, specialized for field of economics, so they had to be done by Nexus Mutual. And investment. So what investment will be done of the staked NXMs in the time frame of the before the cover expires is decided by Nexus Mutual again. And the product development, like how the Nexus Mutual like products look like and how the function is done by Nexus Mutual itself. What the members can do is, as we discussed earlier, they can participate in governance, they can provision for capital, they can do risk assessment, and they are called risk assessors. They can do claim assessment, and they're called claim assessors. So you can also assess the risk when a person is asking for insurance, and you can also assess the claim when a person is asking for claim. So basically, you are a part of the community, and you will be doing everything. And if you do more and more of the things that are required of you, you get rewarded in NXM tokens. So what are the NXM tokens? The NXM tokens represent membership rights in the mutual, with all members owning the mutual together. The value of the NXM token is generated by a bonding curve algorithm, and it's a mathematical equation algorithm. And only members of Nexus Mutual can hold NXM tokens. That means it cannot be listed on any exchange. And a token is needed in order to bind together the internal economics of the mutual. So the platform can dynamically react to conditions of capitalization levels and reward active members for participating in day-to-day operations. So basically, NXM tokens are responsible for awarding the members for good behavior and more participation. And the value of the NXM token goes up and down based on the staking that is being done and the amount of money being poured into the pool, the mutual. So this is a pretty straightforward flowchart that shows how the Nexus Mutual functions. I don't think I need to explain this after everything, but like it's a very simple and straightforward flow. A claim comes in, and claim assessor, as we told you, members of the community, they vote where it is like they should be approved or denied. And if it is approved, then the like if the majority approves, then the payout is given. If the majority does not approve, then notification is sent to all the members, and when all the members vote, then the outcome of the majority is measured. After this, that is all that I had to explain for the Nexus Mutual and the Nexus Mutual protocol. And the idea that I was thinking is that suppose the big problem that people have in their mind regarding cryptocurrency, Bitcoin, or blockchain in general is that suppose I put money in my bank account, say HDFC Bank or ICICI Bank. So I know that my money is protected under a guarantee of RBI. So that gives people a sense of security, but such things do not exist in like blockchain simply because of the nature of decentralization. So I thought that maybe I could pressure people into getting an insurance cover for the smart contracts where the money of other peoples are involved by creating a dashboard that shows all the smart contracts of the companies that have taken a cover from Nexus Mutual and for what amount. So how this pressures people who have not taken insurance is that when a hacker sees that okay, this company has taken an insurance for this much for a smart contract, and so this probably implies that their smart contract is foolproof. But these all people have not taken any insurance, and they have put in a large amount of money in the blockchain. So maybe let's try to exploit them. So I think that this may kind of make taking insurance for your smart contracts convention. So that is what I think. So that is what I will be building. And thank you. Any questions for me are welcome.
Yeah, any questions, anyone?
Hey Rahul, have you looked into Opine? Because Nexus Mutual's more decentralized form, I believe at least, is Opine. Have you looked into Opine for and compared the structures and then come into Nexus Mutual, or you've not looked into that?
No, I did not specifically look into Opine, but I heard there is.
So they were. So Rahul was assigned to explain Nexus Mutual. So.
Oh, cool. But anyways, if you want to diversify, do look into that, because I believe that's a improved version. That's again my opinion. I believe that's an improved version of Nexus Mutual. So if you
Which
want
one
to
are you referring to, Pranav? Which one is a more improved version of Nexus Mutual?
I mean, in insurance, Opine, like giving insurance via put options. opyn.co.
I think Opine is doing something extremely different to what Nexus Mutual is doing. Okay,
but
Open is a protocol for options. It can also be leveraged for insurance, but I think a more similar corollary will be cover protocol, right? So if people want to look into a little bit more of something, what Nexus Mutual is doing, I think better head to cover protocol. It's a more responsive team in case you're trying to build on top of it as well. Nexus Mutual is growing big. It's like $1 billion protocol, and the team has become a little bit slow in its response times. Open is something that can also be used to hedge your risk, but it is not akin to like an insurance protocol, right?
Right.
Insurance, it's more of a
go ahead. Sorry.
Mutual, right? Both Nexus and Cover are mutuals and are not insurance protocols in that side. And Open is totally different. It's got to deal with on-chain derivatives and options, right? So a little bit, it can be used. Options, the inherent need or the inherent purpose that they serve is to hedge risk, but it can also be used for other purposes, right? Like for speculating on gains as well, right? I think this, when you talk about insurance, it's more about capturing or removing the risk element and not the upside, right? Which options also tackle. So,
right. Yeah. Anyways, I was just saying, Opine diversifies the, actual opinion to insurance, right? It's not just insurance, but something more to that. But insurance is one part of it. When Opine launched in V1, it was more about insurance only. Now they are, diversifying into options. Their V1 being, active till now with American options is a good way to actually, go ahead with that. Actually, when they launched, they were, more of thinking to actually just attack Nexus Mutual, so to say, in for the lack of a better term. But anyways, as they have diversified, you are definitely right to that. But I believe they do cover the fundamentals, and actually they are better to build on, since they have a lot of open APIs to actually, go ahead with, and they have a lot of these bounties to go ahead with. I know this because I was applying to one of these bounties. So yeah.
No, that's super. We're actually building ourselves on top of Open, right? We're building something called Options Coin.
So very familiar in the DeFi dollar space.
Yeah.
Oh, so that's super cool. Great.
But yeah, I think coming back to the point, right? So Open currently in its V2 is a European style catch settled options, right? Not anymore. So I think it'll get confusing for a lot of people out there because V1 has been deprecated. But I think, if people want to take a closer look at insurance in general on chain or let's say mutuals, I think do take a look at Cover Protocol.
Cool.
Siddharth, can you explain what is option coin?
I think let's take that in the question and answer session. Right? I would love to explain, and I'll go ahead and do that in detail. But I think probably Denver, have you said we'll probably do that around 9 p.m.
Yeah. So the thing here is that now, I think.
Or Denver, we can actually do the Q&A right away also.
Yeah. So maybe Rahul, I think you're done with Nexus Mutual, so maybe you can stop presenting. So just one realization in between that, I don't think it's possible realistically to stick to the timeline here, and we'll be here for hours, which is not ideal in a single go. Probably what we can do is we can we'll be splitting this into 2 halves and do the next half tomorrow. But today, we'll go with one more round of folks presenting, and then we'll see how much we can do. So since Siddharth is already here, what we can do is we can go with the group that is kind of covering the stable coins part, also the lending borrowing part, also Divya's team. So maybe we can have people from that team present, and then after that, we can have questions related to derivatives, insurance, and lending, borrowing, and stable coins all together. Maybe we can do that. Then we can hope to start that by somewhere around 9 p.m. Does that make sense? Does that work, Siddharth?
Yeah, it works for me totally.
All right. So maybe so who's assigned to present on Aave? Can you start off with that?
Actually, can you do this in order, because my presentation for Aave is basically, because I thought it was alphabetically, so I thought Divya was going to be Dipanvita was going to present before me. So can you do that in order, because Dipanvita wants MakerDAO to present. So
Be first. Okay. Sure. Makes sense. So maybe MakerDAO, we'll take MakerDAO first.
Sure, I'll be presenting MakerDAO. Is my screen visible?
I thought Dipanvita wanted to. Let me just check.
Sorry.
No, I was working on Compound.
You were working on Compound, I think. Okay, got it. So
I think MakerDAO before Compound would be useful, because I did reference MakerDAO once.
Okay, fair enough. So let's go with MakerDAO first. Then let's go with Compound. Then maybe we can go with, I think then DeFi dollar will also make sense, and then we can go Aave last, because then the context of all of them will come together.
Yeah, works for me.
Yeah.
Sure. Is my screen visible?
Yes, it is.
Okay. Sorry. Yeah. So I'm Ankur from Team Divya, and I'll be talking about MakerDAO, which is a decentralized stablecoin. So first, let's talk about why stablecoin support is stablecoins. So coming to Bitcoin, Bitcoin has been, as we all know, a revolutionary thing in the world of DeFi. So, but while Bitcoin actually succeeds as a cryptocurrency on a number of levels, it provides an unbiased and efficient and permissionless system to distribute and control data. But actually, it's not very ideal for making a payment or transferring funds, because it has a fixed supply and it has high volatility. Like once Denver mentioned in the call that you could send somebody a payment of $100 using Bitcoin, and by the time it reaches, it could drop down to $50. So that's really not ideal. So as solution to these problems, the concept of stable coins was introduced. Stable coins basically means that it is a coin which attempts to maintain a stable value. It basically fights back against the demand and supply and maintains its value against a certain peg. For DAI, the peg is actually US dollar. So DAI is a decentralized, unbiased, and collateral-backed cryptocurrency. And DAI is designed to minimize the price volatility that occurs in other non-stable coins like Ether or Bitcoin. So DAI basically tries to achieve a value of $1, which means that one DAI will always be approximately equal to $1. So since DAI is a stable coin, it opens up a lot of other use cases. DAI can actually be used as a store of value. Since DAI always maintains its value, if you create DAI worth $50 and store it somewhere, you are more or less guaranteed that it will maintain its $50 value. So it's ideal as a store of value. It's also very good as a medium of exchange. Like I mentioned earlier, I want to send a payment of $100, I want it to remain $100 even till it like reaches a spend run for an indefinite amount of time. Since DAI is a stable coin, like all stable coins are good for me as a medium of exchanges. Then we have two other cases that other use cases that are right now only specific to the Maker protocol, but as the like usage of DAI increases, it will spread to more areas. So by as a unit of account, I mean that so USD is a unit of currency that is used in the real world and for all off-chain transactions. DAI also strives to be a unit of currency. So like DAI, what it wants to do is it wants to be the case that all transactions instead of USD, they are measured in DAI. So since DAI is a stable coin, it can do that because its value never changes. Right now, the Maker protocol internally, all like units are represented in forms of DAI itself instead of USDT. And then as a standard deferred payment, by that, I basically mean that DAI can be used to pay back loans in the Maker protocol. Yeah, because like DAI is a stable coin, so we can use it for that. Then, so after talking about DAI, we have to think about like how we can acquire it. So the easiest way is to like get it from an exchange like Uniswap, or like just ask somebody who already owns DAI to send it to you or get it from a broker. But in order to mint DAI, you have to actually provide some collateral to a contract that is called a CDP, or a collateralized debt position. It's basically a contract which stores your, which is provided by MakerDAO. It stores your collateral, and against the collateral that you supply, it will supply you a amount of DAI that is a fraction of the cost of the collateral that you supply. So the last line is actually very important. Every DAI in circulation is backed by excess collateral. This actually means that if you supply a collateral of value, let's say $100, you won't be getting a DAI worth $100 back. You'll be only getting a fraction of it. That's what it means to be over collateralized, basically. So like this is a very important feature of how DAI works, and like we'll see how this helps in maintaining the DAI price to be like $1. So what are Maker vaults? So assets can be leveraged to generate DAI in Maker protocol through smart contracts called Maker vaults. And generating DAI using the Maker vaults actually creates an obligation to repay the DAI debt along with a stability fee. So by DAI debt, basically what I mean is when you give a collateral to the Maker vault, it generates DAI and it gives that DAI to you. So this actually creates a DAI debt which the Maker vault expects you to pay back in after some time in the form of DAI. And if you want to get your collateral back, you'll have to settle that debt first. And until you settle the whole debt completely, plus a stability fee, which is actually a premium that the Maker vault charges to generate its profits, you can't get the collateral back. Once you repay the whole like debt, you can get your collateral back from the vault. Okay, so now coming to how like there are a lot of like how does the DAI maintain its value? So like there are a lot of things that are happening in background. One of them is vault liquidations. So think about it. When you give a collateral to DAI, the collateral can be a stable coin. It can also be a non-stable coin whose values it can be Ether, for example, whose values like keep going up and down. So what happens is, as I said earlier, all DAI is over collateralized. So let's say that I gave 100 Ether, and in exchange for that, I got 75 USD. I gave $100 of Ether, and I got 75 USD worth of DAI back. Now, let's say that the value of Ether went down, and it's at $75 right now. So now the collateral ratio is 1:1. But the moment the Ether value starts dropping below 75 USD, it creates a problem because now the DAI becomes under collateralized and the value will go down if that continues. So what Maker does is it keeps like checking at regular intervals what the value of the collateral is, and as soon as the collateral to debt ratio falls below a certain liquidation ratio, which is preset in the Maker like protocol by MKR holders, we'll come to that. It basically sells off all the collateral via an auction before the price goes below the liquidation ratio. By selling this, by auctioning off the collateral, basically that helps in maintaining the value of DAI because because the value of DAI is still compensated to like whatever the auction value comes out to be. Okay, so apart from the Maker vaults, there are a couple of external entities that also help in maintaining the like value of DAI and like other things that are happening in the DAI protocol. So the first of them would be keepers. So keepers are very important. They are actually independent actors that are incentivized by arbitrage opportunities to provide liquidity to the decentralized system. So what that means is like keepers are like normal buyers like us, or maybe bots or something like that. They keep on looking at the price of DAI. So when the price of DAI goes down, let's say it falls below 1 USD, what they will do is they will start buying up the DAI so that they can sell it later. So when they start buying up the DAI, the demand increases and the value of DAI shoots back up. And let's say that the value of DAI is going above 1 USD. So now the keepers have an opportunity to sell off the DAI at a higher price and like make the profit back. So once they start selling it, the demand for DAI decreases and the value of DAI comes back down. So this is like target rate, like it keeps following the 1 DAI ratio, like keepers help in maintaining that. Other than keepers, we have two kinds of oracles. So first are price oracles. So price oracles are basically the main oracles that the Maker protocol uses to get all the price feed data. So Maker protocol actually requires real-time information about market prices of the collateral asset in Maker worlds in order to know when to trigger liquidation. So as I talked earlier, like after the collateral to debt ratio decreases below a certain liquidation threshold, the Maker vault automatically starts auctioning it. So to know when to start auctioning it, the price oracles come into the picture. Then we have emergency oracles. So emergency oracles are a kind of fallback mechanism against a possible attack against oracles. So assume a situation in which like the whole oracle infrastructure is targeted by a group of hackers, and like they try to manipulate all the prices of the oracle in order to like trigger liquidation. I think this has also happened in the past. I don't know the exact situation, but let's say that the uh, attackers attack the oracles and all of the the collateral gets liquidated. To prevent such a situation, emergency oracles are allowed to basically freeze the price that are uh, returned by the price oracles and allow all the basically collateral owners to get their collateral back at a stable price. So basically, they freeze the oracles by calling a emergency shutdown, which is function in the like Maker protocol, which freezes everything and like it does a lot of things which I didn't really go into depth there. Then lastly, we have DAO teams. So these are actually individual teams that consist of service providers who may be contracted through Maker governance to provide services to Maker DAO. These are like external entities basically. Like governance facilitators are external entities that have been contracted by MakerDAO protocol to help with governance facilities, or like helping all the communication between governments and etc. Then risk teams are another like externally contracted teams to help mitigate certain kinds of risks. Then we have the DAI savings rate. So this is another way that helps in stabilizing the price of DAI. So DSR is actually, okay, assume that you have a collateral. You are given a collateral. So what DSR is, it allows you to get kind of interest over time on that collateral. So what happens is that DSR rate can be changed by MKR holders. MKR is basically the governance token that DAI provides to people who want to govern it. So like I'll come to that later, but DSR, so what you can do is if let's say that the price of DAI is going up. So what MKR holders can do, MKR holders can lower the DSR rate so that the interest that you get over time becomes lower. And vice versa, if the price of DAI is going down, the MKR holders can increase the DSR price so that the demand increases and the price goes up again. Like this is another mechanism by which DAI maintains its price. Okay, coming to the last topic, which is MKR tokens and governance. So DAI has a system of governance in which it distributes tokens called MKR tokens to people who can vote on any protocol changes within the protocol. Like any decision or any changes that the protocol has to take or there needs to be made in the protocol, the MKR holders can vote on that. And if the sufficient votes are made, then the change will be done. So basically the voting happens in two phases. First, they do a dry run of the votes and they get the overall consensus of the community, like what the community thinks, and then the actual voting takes place. And like I said before, there are a lot of parameters that MKR holders can change. First is the debt ceiling, like how much debt you can take on a particular Maker vault. Then the stability fee, that is how much interest are you going to pay when you pay back a loan you took, DAI loan when you took it against a collateral. Liquidation ratio, as I said, the set threshold if of the collateral to debt ratio, if it falls below that, it will automatically liquidate the collateral. And liquidation penalty is something that is applied when the collateral is being auctioned. So yeah, I think that's it. Yeah. Like, any questions till now, or should I go to the?
Yeah, we'll be taking questions in the end.
Okay,
so
sure.
maybe
sure,
you can just give a very brief thing about the idea you thought about building on it. Then we can move on and
Sure.
take questions in the end.
So my idea was to actually, I couldn't think of an idea that specifically used MakerDAO. So what I did was I thought of an idea that, okay, so my idea is to swap a loan from Compound to Aave using a Aave Flash loan. So I guess I'll give a brief intro about what Aave, Compound, and Flash loans are, but just a brief intro. So Aave and Compound are lending platforms. You can provide collateral in any token or any form to Aave and Compound, and against the collateral that you provide, you can loan any like token that they provide. So like I can, for example, give a collateral of some X DAI, and against the X DAI, I can take a collateral, a loan of some Y USDT. Both Aave and Compound provide this functionality. And what a Flash loan is, Flash loans allow you to take a uncollateralized loan. So for example, Aave and Compound, the normal loans are collateralized, right? Like you have to provide a collateral before you take the loan. In a Flash loan, you can just request any amount of money, and as long as you return all of that money in the same transaction to the Flash loan provider, you can do whatever you want with that money. Just the condition is you have to return all of that money with a premium of 0.09%. Yeah. So what my idea was that, assume a situation in which I took a loan from Compound of X USDT and I provided some Y DAI as collateral to Compound. Now, what I want to do is I want to transfer this loan to Aave, but I don't want to use my X USDT loan that I took. Like maybe I took that X USDT and I invested it somewhere or gave it to someone else. I don't have that X USDT right now to like repay the loan and then get back the collateral and put it manually to Aave. I want just the swap to take place without me providing all the collateral back. So basically, I used a Flash loan for that. So the high level solution is just like this: like take whatever the loan amount I loaned from Aave as a Flash loan, use that to pay back the loan on Compound, and then the collateral is transferred to Aave, and from Aave I take a loan again in on behalf of the owner, and then like the loan amount that I took from Aave is used to repay the loan back to Aave itself. Like the normal loan that I took from Aave is used to pay back the Flash loan. I guess implementation level detail I skip. And outcome is basically that you can swap a loan from Compound to Aave. Basically, you do a protocol swap without actually providing all of the loaned amount. You only need to provide the 0.0009x amount, which is the premium that Aave charges for a Flash loan. That's all that you need to provide. You don't need to provide the collateral. That's the idea. And like I implemented this and tested it on a local hard hat mainnet fork, and it was working fine. I don't have a front end right now, but logic wise, I think it was working.
Fair enough. Yeah, thanks for that. Thanks for that, Ankur. I think now we can move on to Compound.
Sure, yeah, if there are aren't any questions.
Yeah, we'll take up questions in the end, like
Okay,
after.
sure.
Yeah, because all these protocols are related. Yeah, Dipanwata, I want to go ahead with Compound.
Yeah, I'll share my screen. So is my screen visible?
Yeah.
Okay, so okay. So I was researching on Compound, And so we'll first begin with DeFi. We've already spoken about DeFi and how it is the future of finance. So the only thing that I want to talk about here is the fact that DeFi has a few advantages like transparency, interoperability. Interoperability means like when somebody builds a component on, say Ethereum, then it can be used by everyone else. So it's reusable and you don't have to build everything from scratch every time you need something. It's also free for all and it's decentralized. So coming to the components of DeFi, for that matter, any financial system, it should have a currency. So in this case, because DeFi is based on a decentralized network, it will have decentralized currency, which we already spoke about. So DAI is one of the stable coins. And typically you want the value not to vary too much because of reasons that Ankur pointed out. And then you would have decentralized services. There are decentralized exchanges like Uniswap, and then you have money markets. So we are currently exploring the domain of decentralized money markets. So we spoke about insurance as a financial service offered on DeFi. So when we talk about borrowing and lending, we need to connect the borrowers with lenders. There should be some place where a person can borrow from, and there should be the lender should also be able to easily supply assets from his wallet. And there should be an autonomous interest management system such that the person who is borrowing can automatically repay the loan with the interest added to it. And similarly, when somebody supplies the asset to the compound pool, then they can get back like a higher rate of interest as compared to what they supplied. So on crypto deposited, Compound offers a system where you can borrow and lend assets, and not necessarily the same type of assets. You can actually swap like one asset for the other. So as defined in the docs, Compound is a series of interest rate markets that are running on the Ethereum blockchain. So when the supplier wants to contribute, he contributes assets to this large pool of liquidity that is available for other users to borrow. And when a user contributes an asset, then he gets the corresponding C token. So every like asset that is supported on Compound has a C token corresponding to it, and he gets back this token amount that kind of keeps track of the fact that he has some asset on the Compound liquidity pool, as well as he can redeem his assets on a higher rate of interest as what he initially invested in using that token. So the C token is basically like an ERC20 token that can be redeemed for the underlying assets at any point of time. And when a borrower wants to borrow an asset from Compound, then he needs to supply a collateral asset. For example, if a user wants to borrow, say, ETH from Compound, then what they will do is they can supply, or like they want to borrow DAI from Compound, so they will keep ETH as a collateral, and they can get the corresponding amount of DAI that is available for the amount that he kept as a collateral. So this is basically a diagram that shows like the user wallet, the user supplies some asset via this proxy contract to Compound, and Compound gives him back this C token in exchange. So if you go to this website, defipulse.com, this is basically a very famous website that kind of keeps track of the amount of how successful each DeFi platform is. So Compound is currently third with around 5.14 billion USD locked in it. Okay, so moving on, C tokens. So these are the assets that are supported by Compound. So these are what you can provide to Compound as loans. So, and each of these assets is a corresponding C token. So for example, this token corresponds to Ether. Then you have C DAI corresponding to DAI. This is C Uni, and then C USDC. So similarly, for every supported token, Compound provides you with this ERC20 token. So when you deposit some amount of Ether, say, to Compound, then it gives you CETH back. There's an exchange rate at which this happens. And later on, you can keep the amount, like your ETH in Compound for as long as you want. When you want to redeem it, you get back the ETH that is corresponding to the number of C tokens that you redeem for at the current exchange rate, which may be higher, which is higher than the one that you invested in. So Okay, coming to supplying assets. So I'm focusing more on the dev side of the thing here. So what you need is you need to have the asset that you want to supply, new Ethereum wallet. You need the private key. So in case there's a difference between supplying ETH and any other ERC20 token like DAI to compound. So for ETH, you just need the private key for your wallet. But for any other ERC20 token, you need the address of the contract, like the DAI contract or say the USDC contract. And then you need the Infura API key from or the local node to just get an API. And then the perks that you get with only these few things in your at your disposal is that you get the exchange rate, which is increasing over time, and the more people borrow from the pool, the more your interest rate increases. And there is no time for investing, like there's no minimum time or a maximum amount of time for which you can keep an asset and compound. Okay, so this is an interesting comparison that I found. So similar to a Lego block where you kind of have some inbuilt components. For example, you have a person or you have, say, a small house that comes with the set and you build something entirely different out of it. You build a village out of it. So similarly, Compound was also not built from scratch. It was built keeping in mind that all of these other resources are available. So it works on the Ethereum blockchain. It makes use of stable coins like DAI, which again you get from ETH by exchanging using Maker. And yeah, so Compound is basically made of a large number of components, and all of them contribute like Legos, basically money Legos, to build what Compound is today. So for supplying assets for ETH, you would typically use Web3, and then you would call the mint function in the CETH smart contract that exists. So the address for that you can find as well as the ABI on this link. And then you transfer ETH to the Compound contract using mint.send. And as soon as you do that, you will see that the corresponding amount, so you can see the exchange rate at which you will get back CETH, but some CETH will be deposited into your account by Compound. Okay, and if you want to supply any other ERC20 token, for example, DAI, then you would need the address of the DAI contract where it resides on your particular network. So the ABI is the same for all networks, but the address differs from network to network. So you need DAI in your wallet, and then you need to transfer that from your wallet to the custom contract. So typically, if you are using ETH, then you don't really need a smart contract interface. But if you are trading ERC20 tokens, then you would need a smart contract. So this interfaces to the Compound function using this custom contract that you build. This is, say, my contract in this case. So my contract calls the DAI contract, and since it's an ERC20 token, the approve function needs to be executed. And once this is done, then the corresponding CDAI tokens are supplied back to the wallet, to the contract, basically. Okay, so finally coming to borrowing assets. So you need certain, so these are certain terms that are like very frequently used in the Compound domain. So you have collateral, which is basically the security that you keep, the asset that you keep as a security on Compound. The collateral factor is basically the, so if you keep, say, some ether, then how much of, say, some other asset you can get in exchange of that. So that is the collateral factor. Enter market. So when you are borrowing, initially what you do is you supply the collateral to Compound as if you are supplying some loan to Compound. But then you need to specify to Compound that this is the collateral and this is not an asset that I am like, that I can redeem later. So that gives you enter markets. So enter markets is basically used to mark your asset as a collateral. So you can't redeem the benefits using the tokens that you have, but you will have to pay back. Yeah, and then you have the borrow balance and the borrow rate. This is like very similar to a normal bank. So you have your borrowed amount plus the interest to be repaid. That is the borrow balance, and borrow rate is the rate of interest, which increases every block. Again, you can keep it for as long as you want on the Compound, but you have to make sure that you don't go insolvent. So insolvency is basically used by Compound to make sure that whatever assets you have kept as a collateral, if you borrow more than that, then Compound will automatically liquidate a part of your collateral and currently the liquidation incentive is 8%. So borrowing assets. So as I spoke about, the first step is supply assets, similar to how you would supply a loan. Then you would enter markets to mark the asset as a collateral. This is an enter markets function that is available, and then you calculate the amount that you can borrow versus the collateral that you have deposited. So the open price feed exists for this purpose. This helps to get you the borrow rate. I mean the exchange rate at which you can borrow some asset that you want. Then you borrow it using the contracts borrow function, the secret tokens borrow function, and you need to make sure that the amount that you borrow is less than the maximum borrowed amount, and then you can repay it as and when you want. Okay, so this is just like a diagram illustrating the whole thing. And now the best part about Compound is the fact that it's the governance is purely community led. So there's no one centralized authority that decides the compound rules, decides interest rates, and so on. So you have this specific token which actually has no value, but it is used as a voting power token. So this is called a comp token. It's also an ERC20 token that corresponds to one voting power. It's just one vote in the compound governance. And then the best part about this whole community governance is the fact that you don't need to vote on your own. You can also delegate your voting rights to somebody else, so he can actually cast your vote and spend the gas and ether while you just the vote will be cast in your name, but you don't have to spend anything on it. So the applications of this could be the fact that it could be the comp voting power could be delegated to the application team, etc., so that the team can participate in governance instead of the user, and the users can get very transparent insights into the whole governance process. So to build a governance system on Compound, you would need the following components, as I was speaking about. You have a voting interface, you have a delegation interface, and then all of these. So currently the voting weight leaderboard on Compound, this link you can visit and you can see like who has the delegation power right now and who holds the whole governance power in Compound for like various networks. And then you have so like when you are voting, what you do is you typically fetch the governor contract on Compound. You get a list of active proposals, or you can create your own proposal. Then you cast vote. In case you don't want to vote yourself, what you can do is you can delegate by signature. So a trusted third party, that they spend the ether on gas fees, and they while you vote for free. So you delegate this power to somebody else using their private key, and this is done using the delegate by signature transaction. And as soon as this is done, the delegatee can cast vote by signature on your behalf. So that is about Compound. And yeah, and about the project that I was building. So I was able to basically build this API, this Node.js backend for this also, like this was like a proof of concept for me. So this API, if you see, this has a couple of endpoints. Your like the amount that you have invested into Compound, then wallet balance checks your.
Yeah. Maybe Dipanvita, just brief about the idea that you're building, that you plan to build. That just a gist of the idea is enough.
Okay. So yeah, basically what my idea is that so somebody may have invested, say, a lot of assets, say in this case ether, because I'm working on ether, only the ether asset right now. So somebody may have invested a certain amount of ether in Compound, and then he may have been transacting from his wallet after that. So what I did was I am trying to build this like the CLI program that kind of keeps track of your balance. So you can supply a minimum balance and say that I do not want my balance, like a wallet balance, to go below this limit. So what the CLI does is basically it basically fetches your wallet balance. It sees how different it is. Then it also fetches the exchange rate. Then it converts the C tokens that you have, tries to redeem them, and see whether it can achieve the desired balance that you want. And this runs periodically, or like you can just keep running the script so that you don't have to bother about your like maintaining balance in your wallet. So you just the application itself converts your CETH tokens into Ether and maintains the minimum balance that you want in your account. So I have built a part of this right now. And if you see, I was testing it. So I supply some 0.05005 Ether. It had a previous balance of this much of Ether. And now we have supplied a part of the Ether. So now the amount of the wallet balance reduces and you get some CETH in return. And when you track and say that I want my minimum balance to be 0.69, it runs every 15 seconds right now. And it sees the offset and then it fetches the exchange rate and it calculates the amount of CETH that you need to redeem. Then it automatically asks you to redeem that amount of CETH for ETH. Yeah, that's about it.
Looks good. Looks good. I hope it was nice diving into all of this.
Yeah, I'll stop sharing.
Yeah, I think so. Siddharth, can we do 2 more protocols and then we can have questions? Does that work for you?
I think, Denver, let's do one more and then we can jump on to questions.
Okay, make sure. Sure. So maybe let's do DeFi dollar itself. We have DeFi dollar and we have Aave.
Sure.
So let's
Sure,
do DeFi dollar then. Yeah.
Is my screen visible?
Yeah, you're presenting DeFi dollar?
Yeah, I am.
Yeah, cool.
All right. Hi, everyone. I do not have long and lengthy slides like everybody else. So I hope that's not a problem, but I'll explain what's going on in the best way I can. So I'm presenting DeFi dollar. DeFi dollar is what I would say a new generation stablecoin. So that bear with me if I have things that are not true or have moved on. I think the product is moving really fast. So before I go ahead, let's talk about what are stablecoins. I think most everybody has talked about what stablecoins are. They're just pegged tokens that stay fixed to a value, and there are multiple of them, as you can see, and you can keep on tracking them. Why do we need another stablecoin is an important question now, because if you keep looking at Tether, one of the major stablecoin in the market right now, worth $35 billion approximately. There are constant cases of, there's always some fraud going on in Tether, because you can never ensure that are they actually maintaining their $1 peg. And there's no way for us to actually authenticate that as a community. You can only trust either the auditors that they get, or you can trust their word. And the whole concept of pegging a stable coin or pegging a currency to something else came much early. Even the US dollar used to peg itself to gold early back on, and gold used to be maintained in Fort Knox. So you knew that at least, there is a gold stash, even though governments could hide it, but you knew there's a gold stash being kept somewhere else. Another reason why we need stable currencies that we can keep a track of, I'll get into that more, how DeFi dollar works. You can see this is about a week ago, and $1 billion in USDT were minted at Tether Treasury. And that's the scope of how Tether is printing money literally on the blockchain without, let's say, I would say an actual proof. You can't guarantee whether they actually hold $1 billion with them, either in cash or in cash equivalent currencies. So that's one of the reasons why I think DeFi dollar was started, so that you can find a stablecoin that is actually pegged to other DeFi tokens. Talking about how, so 100% of DUSD, which is mintable, is mintable via a proven peg, right? So let's get into how DUSD works. When you try to mint a DUSD, effectively when you are trying to create a DUSD token out of the smart contract, you can provide a couple of tokens, which can either be one of these stable coins, or you can provide a liquidity LP, a liquidity pool token, an LP token. Currently, I think DeFi Dollar only supports Y-Curve, but I was seeing the documentation and they have multiple pools in the working. One of them is SUSD V2. These are nothing but a DEX pool. If you're if you know about Uniswap and all of those, you know how liquidity pools work. A couple of people pool their tokens, and you can swap any of them for any of them with a little bit of fees. So if you provide liquidity to any of these, you can stake that in the DUSD application, and in return of that, mint the DUSD token. At this point of time, it's very important to know that you are actually minting a token by providing a collateral that already exists on the blockchain, right? So there is a track of the collateral that you're providing here. Unlike USDC or USDT, where most of the pegging is happening off chain, and then there's no way to keep a track of that. How exactly is DeFi Dollar better than other cryptocurrencies? I think I've mostly talked about that. Let's talk about it more. First of all, you can diversify your stablecoin risk, especially if you're using the LP tokens. It's not necessary that all of DUSD is pegged against USDT or USDC, but instead it's pooled across, it's pegged across this pool of tokens, right? That means even if in some case, let us assume USDT falls 30% due to some external audit, your DUSD will not fall by 30%. It will fall by, let's say 30% of 30% ratio, assuming all of the DUSD are backed by this collateral. So the main point is that you're not putting your eggs in one basket. If one of these stable currencies fail, you are still safe because DUSD is backed across all of them. Another cool thing that DUSD did was to provide something known as volatility cushion. Volatility cushion, how it works is that I try to make a diagram out of it, but I think the best explanation is by this scenario that was given in the blog post. Let us say that there are 110 DUSD in circulation, which are obviously backed by 110 worth of stable coins, which can be either DAI or USDC or anything. And one of the users stake 10 DUSD, approximately 9% onto the system, right? What happens is now that the remaining 100 DUSD are collateralized with 110 worth of stable coins. That means you are not under collateralized. In fact, you're over collateralized, but that's a good thing. Because in circulation, there's still 110. Sorry, the total number of tokens are still 110, but only that the fact that 100 of them are in circulation. At this point of time, this 10 DUSD can be used to withdraw additional liquidity pool fees that is generated. Basically, the liquidity pool rewards that are generated can be provided to the person staking the token. And that's, you can read about it more here, but that's great for the person who's actually staking it. And that would actually result in a great APR for the person staking it. Now, the worst case scenario is, let us say that these 110 worth of stable coins suddenly break their peg for some reason. And now the value of these stable coins is $100. In that scenario, what has happened is the remaining $100 in circulation, the remaining 100 DUSD in circulation are still backed by $100 worth of other cryptocurrencies. That means you're still pegged 1:1. The only thing that happens is the contract automatically locks the staked DUSD, and those cannot be brought into the circulation. So effectively, what you've done here is you've given a volatility cushion. Even if the stable currencies behind your DUSD fall by 9 or 10%, or approximately the amount that is staked onto the system, you're still having a volatility cushion. That means your DUSD will still be worth $1. In the worst case, that obviously, I mean, let us assume that all USDT fails, DUSD will fall back to 0.8 DUSD in the case that the underlying assets fall down to $80 or something like that. Because at this point of time, we do not have any more staked DUSD to provide the cushion. So the ones that are in circulation will obviously have to be under this price range, because that's the only way you can maintain the actual peg. That's one of the great things that DeFi Dollar does by providing volatility cushion. Also, we mentioned that they're yield farmable. That's where when you provide the liquidity, when you stake it, you get the liquidity rewards from the staked pool tokens. Another thing that DUSD mentioned is it's modular. It was there in the documentation that it's a very easy contract, and the smart contract can be used with other smart contracts. So you can call the smart contracts easily by using to use it in another smart contract. Sorry. I think I covered this as well. That's about it from DUSD. I was about to show DUSD also recently launched their own DAO. It's known as DFD that you can use to decide which other tokens or which other pool tokens to use as collateral for minting DUSD. And you can actually mint the DFDs by providing an LP token that will allow you to make more decisions onto the DUSD platform itself. That's pretty much it for my presentation of DUSD. So that please let me know if I missed something or if I'm wrong anywhere else.
Sure. And Anshuman, did you think about any idea you could build using DUSD? I know
Yes.
that. Yeah.
Okay. So I am not using DUSD as a project, as the basis of my project. We did discuss that we can have an automated contract to purchase and stake DUSD. But I looked into it and I was not sure I could do it via layer 2 solutions, and the gas fee obviously doesn't make sense to do it as another smart contract taking the whole process in. So what I was thinking of building for this part is a escrow kind of scenario for NFTs. The problem was when I was looking into NFT space, which is kind of hot right now, NFTs are being like sold for huge volumes, right? I mean, there was something that came up recently known as hash masks, and the last few of them were sold for 100 ETH each. So that's $200,000 each. And clearly there's a lot of money being flown into this kind of projects, right? And OpenSea is a marketplace that allows you to buy and sell such products. However, the sad part of it is that it charges 2.5% as its fee. So imagine a product making off $2,500 of your transaction just because they're facilitating that transaction, right? The problem with selling your NFTs is like any art or any valuable thing in real life as well. You need to ensure that the payments come through or the art piece comes through. That's why you need something known as an escrow. I hope everybody knows what an escrow is. It's nothing but an agreement between two people that they're going to send whatever the buyer or the seller, that they're going to exchange the assets by using a third party known as an escrow agent who takes care of the assets until both of them either provide the escrow agent with the asset or other contract agreements are met. So the idea that I'm going to exercise here is build an escrow agreement for NFTs, except the benefit that the place where I wanted to get DeFi in, the benefit will go to the seller. Currently, what happens is if I sell an NFT, this is a example transaction on Etherscan of an NFT, a super rare NFT that was sold. And in transaction, the person paid around $100 in fee. And that doesn't make sense. If I'm trying to sell out NFTs that are worth $10 or $12, it doesn't really make sense for me to pay $100 in gas fee, whereas that's something that the buyer should do, because technically in real world as well, mostly buyers cover all the fee that are required to procure a physical good or a physical art piece. So the idea here was that my smart contract would effectively, I'll probably close all of these. My smart contract will effectively open up a way to transact NFTs where the seller doesn't have to pay the gas fee, the buyer pays the gas fee, which will happen in a way where the buyer will first deposit the agreed on price, as well as additional money for gas fee for the buyers, for the seller's side. The buyer will then wait until the contract receives the fund. The contract will then wait for the sender, the seller to send the NFT tokens to the contract. and they will pay for it via the gas masters. There's something called as Open GSN. I should have probably opened that up. But I was talking to my mentor Divya, and there's a way that a smart contract can pay for another client. Yeah, that's known as GSN Paymasters. And at that point of time, once the seller wants to send out their NFT to the buyer, the smart contract will pay them, pay their gas fee, and whatever remaining amount is there will be sent to the seller's account.
Fair enough. So really, really interesting thing that you're thinking of there. Yeah, NFTs and DeFi are a great mix. Yeah, that will do great. So maybe now I think you've covered everything you wanted to, right?
Yeah, there was also a conversation where we could probably take flash loans. The smart contract would take flash loans to pay off for the gas fee and try and do arbitrage in between. But that idea was dropped because it's not going to be always feasible.
All right, all right. Yeah, so yeah. So now what we'll do now is that if anybody has questions related to Maker, Compound, and DeFi Dollar, you can ask them now, and we'll give the fellows who covered these the first shot at answering them, and maybe the mentors can then correct them if they are a bit off. And also, yeah, glad to have couldn't mention earlier, but glad to have Divya, our mentor, also here. Hi Divya, glad to have you here.
Hi everyone.
Nice that you could join in. We also have Stephen from the Ethereum Foundation. Glad to have you over also, Stephen.
Cheers, everybody. Thanks, Denver.
Yeah. So any questions related to Maker, Compound, and DeFi Dollar?
I have a question related to MakerDAO.
Yeah.
So you mentioned about oracles in it, right? Like you have price oracles and then you have emergency oracles. And suppose the price oracles have been gamed, the emergency oracles can step in and stop the liquidity of assets, right? Collateral, right? Is it possible that the emergency oracles can be hacked and like kind of step in to stop a valid collateral sale? And are there any protections against that?
I'm not exactly sure how, if they are like really protected, but actually I was going through the white paper and I remember something along the lines of this being mentioned, but I don't remember the exact like explanation that was given there. It's definitely given in the MakerDAO white paper that I remember. What the situation there is, like why emergency oracles are like sort of resistant to what you're describing.
Yeah. So anybody from the mentors wants to take this up, maybe? Siddharth, if you have looked into it, any idea about this?
So I think it's a very rare scenario, right? I'm not 100% confident because majorly all the use cases get covered by the time they hit the emergency oracle services, right? We had a Black Friday sort of a scenario, right, with Maker when all of these prices came crashing down, and since then there have been a lot of improvements given by MakerDAO, right, to ensure that there is not a single point of failure because of oracle manipulation happening, right, and these walls getting liquidated, right? So I think this my knowledge is antiquated in the sense it's not been updated since the hack, because that is when I followed exactly what is happening. But I think the key thing to understand there is a backup in place with respect to the emergency oracles, and how it is being treated will eventually affect how the vault is getting liquidated, right? So there's a 13% liquidation fee that gets charged in case the vault gets liquidated. So majorly improvements have been there in terms of making sure that more people can come and participate, right? So as to ensure that there is minimum slippage and people who have opened the vault and are getting liquidated do not lose a ton of money, right?
All right. Makes sense. Any other questions about compound, DeFi dollar?
I have a question regarding DeFi dollar. Just a second. Yeah, so as we saw in the talk, like what DeFi dollars do is like they separate out our investment into different stable coins, right? They don't try to act like they don't maintain a separate deposits like what Maker or others do. Like they distribute it among the stable coin. But like in the talk, we also see like stable coins like Tether can't be trusted. Like they were minting large amount of money on their own. So how does the split between different stable coin is decided in DeFi dollar? Like how we decide like we need to keep four in this 3 to 4 stable coins only.
Cool. So how we are currently doing it is we're building on top of Curve, right? Which I think Anshuman tried to explain as well, right? It's basically an AMM, automated market maker. So there's no order book. You don't have to wait for anyone to come and place like the opposite order, right? In order for your swap to take place, right? So in that in Curve, there are multiple pools, right? So we started out when we launched, we started with the SUSD pool. And currently we're building on top of the Y pool, right? Which supports 4 stable coins, which are USDT, DAI, USDC, and TUSD, right? So in essence, what is happening is once a user deposits any of these 4 stable coins, right? They get deposited to the Curve Y pool. And depending on what the weights of the Curve Y pool are, the all of these collateral get split between these 4, right? So there's no way for us to determine that currently. It totally depends on the Curve pool. But that being said, once we keep on adding these liquidity pools, right? For example, the SAVE pool, which will have SUSD and another stable coin coming into the DeFi dollar ecosystem, right? So we will have limits, just like they're there in the Maker vaults, right? That this is the percentage that can be attributed at a max, right, to a particular stable coin, and that is how we will determine. And in the future, yes, the goal is to keep moving towards index where more of these coins are decentralized, right, or probably are more are not USDT, but it's very difficult not to include USDT in any stablecoin index at the moment because of the sheer prevalence of USDT, right? There's no exchange, there's no interface where you can probably go and not find USDT, right? So and for stablecoins, that is the problem in the sense it's a chicken and egg problem, right? More people will not use you until and unless you have a lot of liquidity, right? And until and unless people use you, you won't get liquidity, right? So you have to get listed in a lot of places. You have to provide a lot of integrations, and USDT already has that. So one way to ensure how you can cross that adoption chasm is just include the more prevalent coins right now, and then try to diversify the index, right? Which we are also trying to do, right? So basically, to answer your question, currently you cannot decide what are the weights, but what token holders or DFD holders can decide is which other liquidity pools apart from, let's say, Y pool on Curve can we add, right? And eventually that will decide with capped limits, okay, that probably 20% will go to Y pool, and then the remaining 70% can go to the SAV pool, right, which will have more decentralized coins. So that's how we're planning to do it.
Okay, got it. Thanks for explaining.
Yeah, any other questions about now, like in general about DeFi or anything of the protocols that
Actually,
you've covered so
I
far?
had a question before that I asked, like Siddharth mentioned option tokens. So I was wondering what is that?
Yeah, cool. So, great. So, what I'll do after I think after I'm done explaining, right, I'll also share the write up on the option coin bit. But as I think Pranav was trying to say, right, uh, options can also be used to hedge risk, right? For example, what you're doing in Maker is you're depositing Ether, right? And the liquidation ratio is 150%, right? So if the price of Ethereum comes down and your collateralization ratio falls below that, you will get liquidated, right? As in your vault will get closed and then you will have like a 13% liquidation penalty imposed, right? So what we're trying to do is instead of using ETH directly, we couple ETH with something called as options, right? So simply put options give you the right to sell at a particular price, right? Which is called the strike price. So for example, if Ether right now is trading at $2,000, right? I can buy a put option and say, after a couple of months, probably after all of this madness is over, I want to sell ETH at, let's say, $1,600, right? So that gives you a price floor, which is $1,600, right? And if you hold ETH uh, and also the ETH option, right, on that, the put option, which is provided by Open, then your collateral value will never be below 1,600, right? Because if you have that put, you can exercise the option to sell it at a point in time later, right? So essentially, uh, what happens is now that put option combined with ETH, right, which we call as an option coin. Now that option coin can be used as a collateral, right? And in this, we're not specifying a liquidation ratio like Maker does of 150%, right? It will essentially be something that you pay a fee because a put option is not free, right? You can't have an option to do something without paying any premium. So whenever you mint a put option, you have to pay a fee, and that is the fees that will be kind of the cost that is being borne by the user for obtaining a stable asset, right? Which is denominated with a put option and also the underlying collateral, which is ETH in this case, right? So this is something that we are building with Open, and the option coin is not directly linked to DeFi dollar. The plan there is to include it as a form of collateral in DeFi dollar once it is popular, right? So currently we're building it open source for the ecosystem, and it can not only be leveraged for ETH options, it can be leveraged for any collateral out there, right? So you can have, so MakerDAO only supports certain particular assets, right? If you've seen, because of the liquidity constraints, right? But if you have liquid options markets and then any asset, right? Or you don't even need a liquid options market, you just need a counterparty, right? Who's willing to buy that option. And then you can just use that option coin, right, which is the put option plus the underlying collateral as an asset, however you want to, right? Because it's just protecting your risk, which is very important for traders and institutions, right? And that gives you the ability to probably double down on your sentiment. If you're bullish on ETH, you can use the option coin as collateral to get more stable coins and then purchase more ETH, right? So you're leveraging or doubling down on your position in a way, right?
If I got it correctly, so basically what you're doing, like suppose if I want to lend money in Maker, so basically what I will do is I will buy first this option coin and I will trade option coin and borrow another asset. So in a way, the price of that option coin because of the put contract will be stable.
That's correct. So Maker does not support it. Maker supports a few selected assets, right? At this
Yes.
moment, the whole point here is to not have a lot of dependence on getting whitelisted on Maker, and not to have a fixed sort of a liquidation ratio, right? Which is 150%, right? So when the liquidation ratio is 150%, you have to over collateralize, right?
Yes.
You will probably need like 200% collateralization. So you cannot obtain a lot of collateral. Whereas if you're using a put option, you can buy a put option when Ethereum is trading at 2000. You can also buy a put option at 1800. You can buy it at 1600. You can buy it at 1400. Just that the premium will be different, right? And so it gives the user a choice to choose what premium he's comfortable with, and not like a fixed ratio like what Maker offers of 150%.
So in a way, the price of this option token will be different uh, for every token.
It depends
I
on
mean,
the
because
underlying asset, right?
yes,
So
that's
yeah.
so. I mean, how can someone trade like a cryptocurrency or a token? Let's say if there are a million token options token, and if each has a different value, then how trading for that goes?
No,
Like,
you can trade anything, right? On the 0x protocol, you can list anything, or you can go on Uniswap and create a pool, right? That is not the problem. The critical piece that we're trying to solve here is that you can combine the put option with any asset, right? You can combine it with, let's say, ETH,
yes.
that BTC, right? We're not worried about the liquidity. Now, who wants to integrate it? It is their headache, right? If you want to have a balancer pool, if you want to have a curve pool, if you want to have a Uniswap pool, right? That is something that depends on whether there is demand for it, right? But essentially, any protocol, like even for DeFi dollar, we would want to have this because you're guaranteed, right? Currently, we use only stable coins to issue DeFi dollar, right? But we can also use this because even if ETH goes to zero tomorrow, right? We will still get back that put option price wherever we've taken the strike, which can probably be $1,400, right? And we've issued $1,400 of DeFi dollar against that, right? So that remains 100% backed. So we're not putting any sort of risk to the LP's money.
So one question, with options, there is an expiry date, right? So, so how are you like?
So exactly, I think you're spot on, right? So that loan will be only valid till a particular point in time, right?
Yes.
And later on, I think this can be an exciting project for anyone who wants to build it as well, right? You can probably have like a tool where people can automate getting top-ups, right? Or probably reissuing their option coin when it is hitting or close to the strike
So
date.
basically, what I mean in that project, what we will have to build is that the collateral will get swapped because of the expiry date of put option. Correct?
So the put option expires, right? So either the flow can be people come to the interface and redeem their underlying asset, or it can be automated, right? Like the Keeper network does automations on chain that you can just subscribe for that service. And if you don't come and cancel it or you don't manually intervene, there can be another put option, right? But it's not that straightforward because you'll have to figure out how open is treating that option at the time of expiry, because they automatically trigger, right? If your option is expiring in the money, they will automatically trigger it, right? So yeah, I think that might be a restraint on the tech, right? But this is something that to probably think about.
Yeah, but really cool. Really cool idea.
Yeah, I even shared the article on the chat. Anybody wants to look at it.
Thanks, Denver.
Yeah. So any other questions in general about mainly focusing on the protocols that we have covered so far today?
Another question, Siddharth. In case of when we do a coin plus its put option, when the coin appreciates, let's say I've put in ETH and the put option for ETH, when ETH is appreciating, am I not losing out? Isn't it in a way over collateralizing the DUSD system itself?
You are right, and that's the whole point. It's a risk hedge, right? When you're hedging, you're protecting against the worst case scenario, not the best case scenario, right? So usually the bet or the thing that people are worried, right? It's just like insurance, right? If everything is going well, you don't need insurance, right? But when there is volatility, you want to protect against the downside risk, right? And obviously, there are complex strategies at play, right? You might be long on ETH on one platform, and here you would just want to come and buy a put option, right? To ensure that your risk is hedged. The option coin just gives you another way to play around with these strategies.
Okay, so let us say I issue 100 USD using this system, and the underlying ETH actually doubles in value. My question here was that effectively, am I not leaving space for more DUSD? I know this is a good scenario in a way, but shouldn't that theoretically affect the price of DUSD? Because DUSD was issued, the supply of DUSD was issued with $100 as a peg, whereas the underlying ETH is now, let's say, what, $200 and the corresponding put option.
So that totally depends on the user, right? So the user has, when they buy a put option, they want to sell it that particular price, right? If ETH is more than double the value, they will not want to exercise that put option, right? Because they will be at a loss, right? So
I'm asking in the DUSD system, wouldn't that affect the DUSD system? Because I think I might be wrong in understanding how it works.
So how it affects DUSD is DUSD becomes more secure, if anything, right? Because at the end of the day, when we are issuing something, right? Let's say you give me a put option worth $1,400, right? With one ETH, and I will only give you around, let's say, 1,400 or less than that, right? So even if the ETH value appreciates, the DeFi dollar protocol remains safe, right? Even if it goes down or goes up, right? If it's going up, probably we can issue more, but I think that's a separate discussion, right? Probably over collateralize it in a dynamic way. I think that is something that we can think about. But yeah, because the put option will always expire at 1,400, so we can't actually you use that amount without the user's sort of buy-in, right? Because they might want to just take away that ETH, right, and not settle down DUSD later on, right?
Agreed. I was worried about the upside itself. I mean, what you said, the over collateralization, can you automate that? That's what I was saying, because effectively the DUSD is less in circulation. But yeah, you're right. It effectively makes DUSD more secure in a way.
Yeah, that's correct.
I want to ask one thing, that what happens to DUSD if when option expires?
So when the option expires, right, the user has to come back and redeem, right, their DUSD. If they don't do that, there will be a grace period where we will get the option coin claimed back from the open protocol, right, and settle the protocol debt.
Okay.
Yeah. So I think I'm not too sure how much time you have more, Siddharth.
I have 10 more minutes. That's okay.
5-10 more minutes. Okay. So there were two questions. Since we already have you here, I wanted kind of you to take up like, so that others can benefit from this. So one thing very interesting, like I just wanted to know, like, in your whole journey about being like building DeFi dollar and everything, like what was something that you did not expect, and it turned out to be good in the long run. And what is something that and is there something that you were surprised by and then you had to like cover up for it somehow and make it work? Because that's how I know from like working in such a project, like everything seems to be calm on top, but like there's a lot that goes on underneath. Is there something you can share there?
I'll tell you one incident, right? So recently, I think someone mentioned it as well, that Vion, right, was hacked, right? And I woke up, I was sleeping, right? And it was the YDI pool which got affected, right? Which we also use. But it turns out there are two YDIs, right? And the one that we were using in our protocol was not hacked, right? So there was like a sleepless 3 to 4 hours, like in the middle of the morning, when the team had to get up and ensure, right, that the funds were not at risk. So this is part and parcel of Ethereum's composability, right? Because when you're building on top of another protocol, you can't get that other protocol also audited, right? You can only get your own smart contracts audited. Otherwise, this is like a whole loop. You will just keep on getting audits and more audits, right? So even though Vion has been functional for like around a year, right? But still there was a hack that happened, right? So you can never be very sure.
Yeah, I think Vion is the most is the protocol people have most people have eyes on, right?
Yeah, exactly. So, and it's just like even when someone was explaining Vion, right? It just has so many moving parts right now, and it started as a very simple thing, right? Just kind of getting more yields or automating the yield farming bit, right? But now it's got so many walls and so many complex strategies which are being crowdsourced at this moment, right? So there are a lot of things which can break, and that's why there is so much more focus coming in from the open source ecosystem for audits and like audit DAOs, right? Like people can just have ongoing bug bounties and they can just keep checking protocols if there are any weaknesses. So would love to encourage you guys as well, right? Because just a little bit about myself. So my journey started with ETH India, right? And Devfolio had like a great role to play in that back in 2018. So although I don't code myself, but there are a lot of opportunities even for people who don't code, right? And just come and understand how these protocols work. Because my job is not to code, but to understand how all of these protocols work and what are the possibilities of working or probably deploying on one protocol on the top of other, right? Or what you can leverage. Because for us, not a lot of people know about us in the Indian ecosystem. We've got a lot of hardcore users, which is spread across the globe, right? But one thing that we've not done is like a lot of marketing, right? So you don't see a lot about DeFi dollar being talked about, but we've got a very solid user base, and we have around $13 million worth of volume in DUSD, right? And $5 million in our savings account. So quite a lot of volume coming from a team based out of India, right? And like working on the cutting edge of DeFi. And we're working with the best teams, right? We're working with Yearn, we're working with Cover, we're working with Badger as well, right? So it just goes on to show for all you guys out there who are just starting out in DeFi that once you start building, right? I think the Ethereum ecosystem is very open. And if you reach out, people will be very receptive to explain and to guide you, right? In what direction to go. And you can just work with any protocol, right? You can start working with Yearn and leverage like $1 billion protocol, like just in a turnaround time of like whenever you're ready, right? It can happen in a week, it can happen in a day, right? Once you guys are ready. So that's the power of the Ethereum and whole open source finance, right? And the DeFi movement, right? So would encourage you guys to do the same, and not just on DeFi dollar. I think DeFi dollar is a very small cog in the wheel. We're trying to tackle the risk problem, which not a lot of people understand, that needs to be tackled right away. It's not a very stylish product to have in a bull market, right? Where people are chasing like 100%, 200% APY yields. But yeah, I think as the space matures and a lot of people come in, people will try to figure out which stable coin to hold, right? So even for you guys, I'm not sure how many of you hold stable coins, but there are, once you just come into the ecosystem, right, it's very overwhelming. There's USDT, there's DAI, there's USDC. Which one should I buy, right? Probably let's go with the one that's available on the Indian exchanges, right? Or probably on Binance, and just get BUSD, right? But our goal is to ensure that whenever someone is getting onboarded to the DeFi ecosystem or crypto in general, they have like a stablecoin index, which gives them the benefits, all the benefits of holding a diversified index. So that protects their value against price fluctuations and volatility, while also giving them a chance to participate in yield farming and get attractive returns, right? Yeah, so that's basically in a nutshell what we're trying to do. But yeah, that apart from that, I think I'm just excited listening to all of these ideas, right? Even though I think the flash loan bit you guys have tried to explore, and I don't know, whenever you guys are presenting that, would love to come back again and just see what gets built, right? Because the ideas are really exciting. Now it's up to you guys on how the execution goes, right? And also to the mentors, because they will have to guide you to get there. So yeah, just excited to be a part of that journey.
Yeah. So yeah, one I think last question, like based on the time you have, like for you, like how, I think like as far as I remember, you have a background in engineering mostly, right? And then then after that an MBA also or something like that.
I'll just give a brief introduction, right? So I did my engineering from BITS Hyderabad, right, and Tripoli, electrical and electronics. Worked in data analytics for a couple of years with Mu Sigma after that. Then went ahead to do my MBA from XLR Jamshedpur. Again, went back and did like 6 months with a data analytics firm. But by then I was already into crypto, majorly via trading. So one of my friends who was working with KPMG back then, right? He just introduced me to Ethereum while we were on a trek, And since then, it's been a giant rabbit hole, right? And I've just kept exploring. And there's so much to learn, right? I think someone asked something about MakerDAO, and I'm so ashamed I don't know the answer to that. But it's just like a tester statement, right? There are so many things in DeFi. It's very hard to keep a grip on everything that's going on, right? So probably you have to now the space has grown so much that now you have to specialize in one particular thing, right? So yeah. Hey Akash, yeah. Always
Any advice for people picking up all of this finance things, like based on your own journey, like any advice?
I think my advice would be don't jump into developing something, right? I think there are so many things and so many protocols that first what you need to do is try and understand what is happening, right? And what are the gaps? Probably you would see something from a fresh perspective, right? I'm so used to all of these protocols that it's very tough to me to take a step back and imagine what could have been done differently, right? So uh, the best thing that you can do is jump into these Discord discussions or Telegram discussions and just ask questions, and whatever you think can be improved, I think you should definitely pursue that, right? Because don't think that you guys are late. Nothing is late. DeFi changes so much, right? In just the past 1 year, right? We didn't have anything called an AMM, right? Uniswap came and changed the game altogether, right? Now they're giving Binance and all these centralized exchanges a run for their money. But yeah, I think the same thing is going to happen with on-chain options. But yeah, not just these things. I think there are a lot of things, right? I had no clue that there can be something called a flash loan, right? Which is which is something, if you try to explain to a non-crypto person, right, that you can borrow any amount of collateral and you can return it very quickly and just have to pay fees on that, right? Which blows my mind even now, right? So these are very powerful primitives in finance which are getting built on Ethereum, and it couldn't be like a more exciting time to work on all of this, right? And there's just so many protocols. I think all of you couldn't even present it in one go. There's so many protocols, so just dive into as many as you can, and then not as a part just to build, but also to understand, right? Because it gives you a perspective of what is already there and what can be built and what are the gaps, right? And it's always good to solve a problem that you guys are facing yourself and just build that idea out.
All right. So I think, so just to clarify, like we are done with all the presentations for today. We'll probably hold the next set of presentations tomorrow. So I just wanted to check with everyone if there are any final set of questions. I'm not too sure. I don't think Siddharth has much time, or doesn't have time at all. But then, are there any final set of questions any of the fellows would like to ask before we call it a day? Anything related to DeFi, crypto, anything you have not understood? Because I know like all of this can be pretty overwhelming to understand. Okay, no one? Everybody all good with all the questions?
Guys, I just posted a tweet by mistake. What I intended to do was post my Telegram ID. So in case you have any questions or anything at all, right, that you want to discuss, or any follow-up questions as well, just feel free to hit me up, and would love to clarify that, right? And it was brilliant being here. Thanks for having me, Denver. Unfortunately, I have a meeting and I have to drop off.
Sure.
But yeah, thanks a lot for having me, guys. Yeah.
Sure. Thanks, Siddharth, for joining me.
Bye-bye.
Yeah. Yeah, so any other questions, or should we continue this tomorrow?
I wanted to ask, I mean, I am the last fellow from the VAS cohort. So is it all? I mean, what's the situation? No, because the lending and borrowing and my whole PPT kind of depends on Compound Maker. So
yeah, I think
my PPT around that. So.
Yeah, so should we just do that now, so then we can at least wrap up that part?
Yes, that's what I was.
Yeah, is everybody okay with that? Does anybody from the fellows have to leave right now? or because it will take, I think, around 15 more minutes.
Oh, my PPT is really short. I made sure that the important part was covered by Ankur and Dipanvita. So I will only focus on differences. So my PPT is short.
Okay. Sure. Yeah, let's do it.
Okay, so I will share my screen.
Yeah.
Okay, so is my screen visible?
Yes.
Okay, so my name is Pranav and I'm from the VATS cohort. So basically, I will be explaining Aave. And the thing about Aave is that Aave does everything that Compound does and better and more. So what it does better and like what it does more, I will be jumping into that, because the same with Compound, it also has the core lending and borrowing part. With Compound there is C token, with Aave there is A token, and Dipanvita explained beautifully in her slides, so I won't go into that much. Let's see. So Aave is a decentralized non-custodial protocol. So nobody explained what is non-custodial. So it's a simple term. So non-custodial means that basically the user is in control of their own assets. Okay. So user can deposit some assets into Aave reserve pool, and they can earn interest on it, and they can also borrow provided they have enough collateral. So same thing with the Compound, same, like exact same procedure. So Aave's market capitalization went from 500 million to $6 billion in less than 6 months, and that is mind-boggling. So how exactly did they do it? Because the history of Aave is that basically it was a different company. They named Aave after, I think, 2 years, because the first product that they were focusing on were gasless transactions. But then they realized that they are too late into the market. So they switched it. And in a span of 1 year, right now, the total assets locked in Aave is over 6 billion. So yeah, that is mind-boggling.
Just sorry to interrupt, but were you talking about ETHLend? Because before this we were doing
yes. So basically, before Aave, their name was ETHLend, but yeah, they changed their strategy completely. What exactly is Aave doing differently other than Compound? So 4 things that they are doing differently. So first thing is that, as I mentioned, they are doing it better. So by that I mean that Aave supports like more number of assets than Compound. So it has over 20 different assets compared to Compound, which supports only 11, and also it has the most number of stable coins. Hello. Okay. Second thing is it is faster. Aave is more innovative and faster in implementing additional services, because see, the thing is with Aave, the community, they really respect their community, and they try to get as much user interaction as possible. So they are really focusing on what the community wants, and according to that, they are implementing additional services. So that was the better part. Now what they are doing differently. So there are 2 things. First is stable borrow rates. So Aave has so basically there is something called as interest model. So basically interest model is something when you are lending, how much interest you are going to get on that, like the profit. If you are borrowing, you are supposed to give interest, right? So in these pools, the interest rates are variable on Compound as well as on Aave, and that interest rate fluctuates on demand and supply of the pool, right? So but Aave also provides this stable rate. So they have recently introduced this like stable rate model in their V2, and based on the statistics, they mentioned that only 98% of users use this use variable and only 2% use stable borrow rates, because the stable borrow rates are twice as much as variable borrow rates. But why is there a need of stable borrow rates? Because if you see in traditional system, stable borrow rates result in less risk exposure. So yeah, when it comes to a financial application, predictability is something that everyone values. So they are in just a baby phase. I would say that they are experimenting and collecting data on how can they modify this borrow rate in their version 3 of the protocol. But yes, that is really interesting, because as you can see that there is a $6 billion of assets locked in Aave right now. So 2% of that, you can imagine, like the big investors, that they are actually using stable borrow rates because they can predict what will be the, so basically they can predict. That's why. And the mother of all differences, like everyone was discussing, flash loans. So Aave introduced flash loans. Basically, there are two types of loan. First is secured loan, and the second is unsecured loan. So with secured loan, basically you have some kind of collateral. So if the loan goes bad, you can always liquidify that collateral. But unsecured loan is something that when you don't have collateral. So flash loans don't require collateral, and you can borrow as much as you want, but they are secure loans. So how do they do that? So basically there are three parts to this. The first part is the borrowing part. So the borrowing, like you can borrow as much as you want. Second part is like if you borrow, let's say $25 million, and it is actually possible someone actually borrowed $25 million, and basically whatever you want to do with that $25 million, you can only do that in couple of seconds. So you get to live a life where you are millionaire for a couple of seconds, and after that you have to return that with some interest fee, that is 0.09% on Aave. And if you are able to all of that correctly, and you are able to borrow that amount, so whatever amount you make in between those seconds, you get to keep that. So that's the whole thing that changed Aave from every other protocol out there. And in 1 year, it was valued at second most popular and second most valued protocol of all time. So basically, it stole place of Compound, and now like there are talks like it could potentially replace Compound. But Compound is also big, so yeah, they will handle something. So yeah, that was my presentation. It was really short because everything that like governance and all, it is all present in Aave exactly like Compound. So I won't be repeating that. So does anyone have any question?
Did you also think of an idea to
Yes,
build on Aave?
Yes. So yeah. The idea that I'm building right now, there is this feature, there is something called as. Just a second. Let me share my screen. Okay. So there is something called as credit delegation. So what you are doing is when you are depositing loans into Aave. So some people only want to deposit loans and they don't want to do anything after that. They just want to incur interest on that, and they're happy with that. But obviously a lot of people want to borrow assets, but for borrowing assets they have to first give collateral, and the collateral is the big part. So what Aave has made a functionality where you can basically delegate your credits to some specific address. So let's say if I'm a owner of some deposit, if I deposit some collateral in Aave via its lending pool. So what I can do is that on that on that deposited collateral, I can borrow something, but I don't want to borrow something. So I can basically delegate some other address who will borrow on behalf of me, and he will basically repay the loan. Okay. So basically what is happening here, that the other person is able to borrow without any collateral, and that's amazing. So yeah, so basically there is a functionality, there is this function with the help of which you can do that. So but it is not implemented anywhere on Aves protocol. So yes, I will be making a test dApp for that.
Yeah, sounds great. Sounds great. And yeah, credit delegation is something pretty interesting
Yes.
they came up with. Anybody has any questions regarding Aave?
I think everyone is right now.
Yeah, no, either everybody has understood everything perfectly, or or they're too overwhelmed.
No, it's just we have to explore a bit on the other
Yes,
protocols as well before asking questions. Like it was really tough getting to know our own protocol. Like we had to scour the entire internet for that.
Fair enough. Fair enough.
True. Very true.
Like right now, we don't even know what to ask, so we need to do some exploring.
I mean, to understand Balancer, at one point I just opened YouTube Medium, searched Balancer, and read and watched everything before I understood how Balancer works, what it actually is. But now I find it pretty interesting.
Great to hear that. Yeah, so unfortunately, Pranav, no questions for you.
No, it's actually fine. I mean, I totally understand what they meant, because I only ask question on lending and borrowing part and options part because I know that stuff. But, for my own, as I said at the start, for my own Aave, I researched for 2-3 days. But yeah, I can understand. It is really tough to understand everything in 2 minutes.
Yeah. So just like the two cohorts that presented today, just so the logic behind the reasoning behind choosing these projects to assign to you is that they're most representative of that particular sector. Did you come across any other in your research? Did you come across any other projects that in your own sector that we did not cover, and you would like to just mention them?
I think I came across some.
Yeah, go on, Saleh. Go on.
Yeah. I came across something called as UMA or UMA. I don't know how to pronounce it.
Yeah.
Protocol.
Yeah.
Yeah. So it is kind of similar to Synthetics protocol, but it was there before it, and then Synthetics took over. I didn't read more about it though.
Yeah, I think UMA has been there for a while, and yeah, I think it'll it's expected to pick up in the coming months. Yeah.
I see. Okay.
So yeah, anything? I think there were a couple of more even in the insurance space that that we had cover protocol and others. So maybe I think the best place to research all of this is just go to DeFi Prime. I think many of you must have already looked at it, DeFi Prime and DeFi Pulse. So maybe you can go and search for even more things because there are a lot of things out there.
Project in my group, stable coins and all. There's something known as the Ample port, which I really like. They don't have any peg. They're supposed to be a stable coin, but they maintain their peg algorithmically by trying to rebase the supply. They contract or expand the supply of the tokens in every person's wallet to maintain their peg to $1. They don't keep actual USDTs or any other currency to maintain their peg. So that's pretty cool of an idea to work around.
Yeah, but I don't know much, but then I'm not too sure how practical that is, because have they been able to maintain their peg using this mechanism?
Yeah, so on a longer average, they have. So on short term, while it does move very wildly when people are trading it for profits, because when they rebase, there's a lot of scope for making profits. But I think on the dashboard, I'll find a link if I can. There's a place where they show that for the past 1 month or 1 year, what their average price has been, and that has been always very close to the price that they're trying to achieve, which is $1.09, according to some calculations on purchase parity.
Okay.
I'll try and find but for largely they've been able to maintain it. Their ideology is, even despite the wild fluctuation, their average and the median prices across 1 year stays around the peg that they decide.
Enough. So there were two stable coins, in fact, just talking about the largest market cap ones that we didn't assign to anybody and didn't cover, just because they're not like decentralized. So the ones that we covered today were DAI and DAI by Maker and DeFi Dollar. So there were two others. You should know about them. One is Tether, USDT, and USDC. So both of them, like, they are they're centralized basically. So you should know about them, but they are
only
far
DAI
ahead
is
in
the-
market cap. Yeah.
Only DAI is one of the stable coins that are like completely decentralized. All of these others are at the end somehow managed by big companies.
Yes. Correct. No, all of the others means like there are other stable coins also,
Like
but
USDS and USDT are as I remember, only DAI was the one who was mostly decentralized. The USDT and USDC, they are more like managed by big entity. 2-3 big companies coming together and managing it. They're not. I don't think they're completely like follow decentralized things.
yeah, they're not. But I don't know about any other centralized coins as such. I'm probably not aware because they don't have a large enough market cap. So Tether has a market cap of, from what I can see right now on Coin Market Cap, it's 30. Is it 34 billion? $34 billion. If I'm reading this right. Yeah, $34 billion, and USDC has somewhere like $7 billion. And then after that, DAI is much lower, somewhere like $2 billion. So the goal here is then to increase, everybody in the DeFi space, the goal is to increase use of decentralized coins like DAI, and then of course, DeFi Dollar, like, as is trying to diversify the risk also. So that is also, the goal here. Right. So is there anything else anybody would like to ask, or anything, or like we can be done for the day? And I hope
Denver,
yeah.
I have one question. I guess Ankur said that the stable coins have an edge over Bitcoin because their value is stable. So does that mean that they will take over Bitcoin anytime in future?
So the purpose is very. Oh, you're talking about. I don't. Who said that? Ankur said that. Did you mean to say
So,
that?
like, stable coins in certain applications, yes, they're better than like Bitcoin or Ethereum, but I guess Bitcoin has its own uses. Like, I think the main selling point of Bitcoin right now is that it has a very large market value and has been like the genesis of cryptocurrencies.
Yeah. So basically,
And
yeah.
I
Go
don't think
ahead.
they cater to the same use cases.
Okay.
Yes. Correct. So the use cases are like different here. Bitcoin is like, people are considering more like a store like a store of value, like gold, something that you accumulate over long time, but also appreciates in value. So like gold, like you can use gold as money, but then it wouldn't be as attractive. First of all, gold is scarce, right? And yeah, then the whole value proposition is that it is supposed to increase in value and you can use it. So whereas the whole point of stable coins are that they will always maintain a single value, which is a hedge against anything else. Yeah.
I think the purpose of stablecoins is to replace the current currencies that we have, not compete with crypto, like pay salaries in stablecoins and stuff like that, but not compete with the crypto, which have a very fluctuating value in market.
Correct. Yeah. Yeah.
But then stable coins are also cryptocurrencies, right?
Yeah, they are. But so I was reading this article. I was watching this video, I guess, which was in this week's Notions assignment, I guess. And maybe it was that video or else it's to some other video. But the person basically gave an example. So he lived in Argentina, and whatever currency he was getting in Argentina, that was somewhere like 49 or 50 Argentina currency to $1. And in 1 year, that went to 145 of that currency to $1. So his salary got depreciated by a lot. Like he was giving an example, and the person had moved from Argentina to US. So the example there and the analogy there was, if he would have gotten his salary in terms of a stable coin, then the value of his salary wouldn't have depreciated by 1/3, and that's a huge loss to someone who's moving. So that way, if the normal currencies switch to some stable coins, we can have a bit more uniformity across different countries and stuff like that.
Got it. Thank you.
Actually, like the whole, like if you know about the economics of Argentina, their currency is quite unstable. Like they have even replaced their whole currency to 1-2 times in the past, and even today it's quite volatile. Like someday, sometime in the past decade, like it has become from completely worthless to a lot of value. So over there, even trading in Ethereum and Bitcoin also possesses a risk of losing all the value of the money you hold. So like a lot of people over there have started to adopt stable coins because they're backed by like the US dollar.
Yep, makes sense.
Cool. Anything else? Any other questions?
I would just like to ask one thing not related to today's discussion, but since everyone is there any way we can shift the meetings from any day out, but not tomorrow, if that works for everyone?
Or we don't want to do it tomorrow?
Yeah, just have some plans for Sunday,
Yeah,
if that
makes
works for everyone.
Does that work for others also?